I'm sure you noticed that we are currently living in quite unprecedented times. Soaring inflation, which brings up the cost of living, geopolitical disputes that are responsible for conflicts in various parts of the globe, and extreme weather conditions that cause floods, hurricanes, wildfires, and droughts. Our world has become increasingly unpredictable, and large hedge funds are taking advantage of this and are making billions of profits betting on catastrophe bonds and other insurance-linked securities. 2023 has been one of the most successful years for hedge funds betting on so-called cat bonds, which achieved an annualized return of 19.7%. Not much is known about this huge bet by hedge funds on natural disasters, as their appetite for investing in these kind of instruments drives demand for cat bonds, which can be perceived as unethical because human suffering is usually involved in these kind of catastrophes. So let's shed some light into this world of catastrophe bonds and find out how cat bonds actually work, why they are so attractive nowadays, and who the biggest players are that made billions of profits last year. German insurance company Allianz sponsors a new catastrophe bond that covers European windstorm risks. Crédit Agricole places its first 160 million cat bond, and Fermat Capital Management, a specialty investment management firm focusing on insurance-linked securities, is close to reaching $10 billion in assets under management. These are only a few recent headlines in the catastrophe bond business, which is currently one of the hottest alternative investment sectors due to its significant returns and positive outlook. But let's take a step back and first start with the basics. What actually is a catastrophe bond, and why are more and more hedge funds investing in these kind of investment vehicles? Essentially, a cat bond is a debt instrument created for insurance companies to raise money in the event of a natural disaster. So imagine, you are an insurance or reinsurance company such as Allianz, Swiss Re, Canada Life, Lloyds, and so on. In the event of a natural disaster, you would need to pay for the insured damages. But what if you're unable to cover the damages with the invested premiums? What if you don't have enough money to pay for the damages? Well, in that case, you as an insurance company need an insurance for yourself. And you can do that by issuing a so-called catastrophe bond and transfer the risk to investors. Investors will most likely be hedge funds, pension funds, and other institutional investors because they can receive a higher interest rate on cat bonds than from most other fixed income securities. If the specific event, let's say an earthquake or tornado, happens, the issuer of the bond, so the insurance company, has the right to receive funding from the bond and defer or completely forgive interest payment to the investors. Cat bonds are a type of so-called insurance-linked securities, which have been the hottest hedge fund play in 2023. As you can see, cat bond issuance has grown over the recent years and reached an all-time high of $16.4 billion last year. The entire cat bond market now exceeds $41 billion. They are so attractive to hedge funds because they can receive quite high fixed interest payments over the life of the bond, as mentioned before, and because cat bonds usually have rather short maturity dates of between 3 to 5 years, there's less probability that an event-triggering payout will happen. Also, hedge funds use cat bonds to diversify their portfolio. As cat bonds are not linked to economic or market behavior, investing in them is a good way to minimize risk. The Connecticut-based investment management company Fermat Capital Management, led by John Seo, is probably one of the most famous players in the insurance-linked securities sector. Seo has a PhD in biophysics from Harvard and a physics degree from MIT. If you think about it, that's actually the perfect educational background for a guy betting on the occurrence or non-occurrence of natural disasters. Seo then worked for the infamous investment bank Lehman Brothers years before its collapse and co-founded Fermat Capital Management with his brother Nelson in 2001. 2023 turned out to be one of the best years ever for the company, as the total return on cat bonds reached incredible 19.7%. A managing director at Fermat even called 2023 a unicorn year, as there was unprecedented investor interest and rising demand for cat bonds in the market. Fermat Capital Management is the world's biggest investor of catastrophe bonds and is close to reaching $10 billion in cat bond assets. And as the number of natural disasters is rising and more insurance companies seek to offload their risk, the potential for profits is rising as well. CEO John Seo is estimating that cat bond issuance could be even larger in 2024 and is already betting on the latest segment of the catastrophe bond market, namely on insurance against cyber attacks. I mean, that absolutely makes sense. Cybercrime is expected to skyrocket in the coming years and cause estimated costs of roughly $24 trillion in 2027. Yes, you heard right, we're talking about trillions here. That's absolutely huge. Actually, in November 2023, the Bermuda-based insurer and reinsurer Axis Capital Holdings issued the first cyber catastrophe bond, which allegedly received broad investor support and can now be used as a template for further cyber cat bonds in the future. To be honest, I would not be surprised seeing a company like Google, for example, being quite intrigued by such cyber cat bonds, considering that they are already an active player in the catastrophe bond market and most recently made headlines by seeking California earthquake risk protection for its assets, physical property and employees. But now I'm curious, what's your view on cat bonds in general? Do you see them as being unethical, although hedge funds investing in them hope that the trigger event will not happen? And would you as a retail investor invest in such bonds if they would be available on the bond market? Let us know in the comments, and don't forget to subscribe and leave a like if you enjoyed this video. See you in the next video.